As the management team of a company, your objective is to create value for your shareholders, either by making the stock price grow or by paying dividends. Your investors expect a steady and growing flow of dividends. In fact, dividends is the main factor in the model they use to value your stocks. This model is called the H model. Investors in the real world might use many different methods to value a company, like industry multiples or free cash flow projections. However, your investors are a little simpler and only use the H model. To help you meet your objective of creating shareholder value, we'll now have a detailed look at the H model. Note that you'll also find the equation, explanations, and figures in the dividends task. The H model assumes that the stock is worth the sum of all future dividend payments, discounted to the present value. It makes the assumption that the company first will have a period where the dividends grow quite fast, and then reach maturity, where the dividends just increase at a low but steady rate. The H model calculates the price per share and looks like this, where D0 is the dividends paid in the previous period, GH is the high short-term growth rate of dividends, GL is the low long-term expected growth rate of dividends, R is the required rate of return, and H is the half-life of the high growth rate. Now, the model looks complicated, but let's break it down and make it easier to understand. First, let's try and understand the two parts of the formula. The first component only takes into account the long-term growth rate and represents the slow long-term growth in dividends. The second component represents the short-term by taking into account the short-term growth rate and the half-life. Now, let's make the model easier to work with. When your investors use the model, they use a fixed half-life, rate of return, and long-term growth rate. This means that the only variable you can directly impact is D0, the dividends paid in the last quarter. Indirectly, you're also in control of the factor GH, which you can see the details of in the dividends task. This effectively means that if your dividends paid over time increase, then so does your stock price. Conversely, if you one quarter paid less dividends than you did in the previous, then your stock price will decline. Effectively, this means that you should steadily increase your dividends as your company grows and try to avoid drastic increases or decreases in payouts. This is easier said than done. Remember, your stock price is affected by your dividends, which are part of your net income, which is the result of your revenue and your costs. That means that you're going to have to manage the entire company well if there's going to be any dividends to pay in the other end. As you might suspect, the H model could make your stock price extremely volatile. A high dividend payment can send your stock price to the moon in one quarter, only to plummet in the next if you're not as profitable. Your investors understand this and apply a neat technique to make your valuation a little bit more stable. When calculating the stock price with the H model, they use the average numbers from the previous 2 quarters. You'll be glad for this when things don't go as planned. Before we finish up, let us give you a few final tips. First, don't pay dividends until you're ready. When starting out, your investors bought your stock at a price of $200 per share. Your stock price will remain at this level until you start paying dividends. If you start paying dividends when you're not very profitable, then the H model will punish you and give you a much lower stock price than you initially had. This will limit your access to new capital and can cripple your company. So in most cases, you shouldn't start paying dividends until it increases your stock price. Note that this is the case for your company in the simulation and might not be the case for all companies in the real world. Next tip. Remember that issuing more shares impacts your investors' returns. If you issue, say, 50% more shares, then you also need to earn 50% more profits and pay 50% more dividends to give your investors the same return on equity. Of course, this doesn't mean that you never should issue more shares. Sometimes it's completely necessary to build a sustainable business. But be aware that if you take on more equity, then you'll also need higher earnings to pay more dividends. Now you have everything you need to make your own dividend strategy. Good luck and have fun.